We're here today with Kim Stewart at SIS Bank, which has 9 branches in southern Maine and New Hampshire, and we're here to talk about credit scores. People at SIS is a bank that are really here to help and really want to work with consumers, and Kim is going to tell us a little bit about what we can do as consumers to improve our credit scores. Kim?
Good morning, Randall. Good to see you again.
Nice to see you.
What is a credit score? Well, a credit score is the statistical probability of a consumer paying back the money that the bank is going to borrow. And there's a range of credit scores that go from 0 to 850. And you can see that depending on how high the score is, it's associated with risk. So the higher the score, the lower the risk, and the lower the score, the higher the risk. This risk rating comes in the form of a number, and the numbers are all calculated using different payment factors. So your payment history on your credit report accounts for 35% of your credit score. One of the things that we like to tell our customers is that it's very important to pay all your bills on time, and if you've missed any payments or gotten behind, bring yourself current, because the longer that you can have a current history, that gives you the opportunity to rebuild the score and the points that you might have lost. The second area is the amounts owed. That counts for 30% of your credit score. Keeping balances low on credit cards and other revolving accounts is a good thing. If you maintain balances below 50% of the credit line, again, you'll have a higher, more favorable score on the credit report. Length of credit history accounts for 15% of your credit score. And again, what they're looking at is how long you've had the accounts open and how well you've made your payments on that. So keep in mind, if you've only used your credit for a short period of time, it will take a little bit of time for that score to build back up.
Right.
Correct. Next that they're going to look at are the credit inquiries on the loan. And this accounts for 10% of the score. And this is just other lenders, creditors that are looking to extend credit to you. So the history stays out there for 2 years, though we look at the most recent 12 months to see how much credit you've recently obtained. And the best tip is looking at the credit report yourself, keeping an eye on your credit report and the information that's being reported on that. And the very last thing that goes into that credit score is, and accounts for 10%, is the types of credit that you use. So they're looking at, is it a good mix of revolving accounts along with installment loans, credit payments? And just keep in mind, remember that closing accounts doesn't necessarily make them go away. That history remains on your credit report for, again, 7 years is the reporting time. And so sometimes closing account updates activity where you may not want that and lower your score.
Great.
So putting all this together, and the reason that all this information and credit scores are important is when you go to apply for a mortgage and our lender looks at your credit score, this is what you can expect to pay in addition to your closing costs. So the higher your credit score, the less your closing costs will be. The lower your credit score, you're going to have points and higher fees associated with it.
Good. Well, that's really good information, Kim. Thank you.
You're welcome.
Good. So Kim Stewart at SIS Bank helped today letting us know that as a consumer, there are things that we can do to control our credit score, and we should. We have to take responsibility for them. If you have other questions, contact Kim, contact the folks at SIS Bank. They're here to help. Simon says this is something you can control and something you should.